Hi everyone, Todd Weick from Potomac Financial Group here. As many of you likely know, the CARES Act was recently passed by Congress and then signed into law by President Trump on March 27th of this year. And included in this historic relief package are several tax-related items that I think everybody should be aware of. And we recently sent out a letter to all of our clients detailing many of these changes. So if you missed the letter or if you want to learn more, you can find it on our website at potomacfinancialgroup.com. But I also wanted to put together this short video and go over a few of the important changes and discuss how you might be impacted. Now, from a timing standpoint, I think perhaps the most important change is the tax filing deadline. It's been extended to July 15th of this year. Now, this extension applies not only to the filing of your tax return, but it also applies to any payments that you might owe the IRS this year. So essentially, it's acting as a 90-day interest-free loan, and that should help many Americans that just might need a little bit more time to make their payments, especially if it's a large amount that's owed. And so if you're expecting a refund this year, I don't think there's any reason to delay filing, and you should submit your returns as quickly as you can, just so you get your money as soon as possible. However, if you're likely going to owe the IRS money this year, I think it's going to make sense to delay making your payment and take advantage of that additional 90 days. Now, many states, such as Maryland, have followed suit, and they've also extended their tax filing deadline to July 15th. And so check with your tax professional or your state's website and see if your state has also extended their deadlines. Now, along with this tax filing extension, we've also been given an extension to make our IRA and Roth IRA contributions for 2019. And so we also have until July 15th to make those contributions if that's something that you were planning on doing. Now, perhaps the biggest change from a tax standpoint that was included in the CARES Act is required minimum distributions have been waived for 2020. And so for anyone that had to take a required distribution from an IRA account, 401k, 403b, or any other retirement account, including beneficiary IRAs, you will no longer have to take that distribution this year, and then these RMDs will begin again in 2021. Now, on the surface, that seems fairly simple. But what we're realizing as we go through this, there are many nuances and questions that are arising from folks who have already taken their distribution earlier this year. So we're still waiting to hear from the IRS as far as how these distributions will be handled and what options we might have. What we do know is that if you have taken your required distribution or a portion of your required distribution within the last 60 days, that money can be returned into the IRA as an indirect rollover. But what if your distribution occurred prior to that 60-day window? What options do we have with those situations? And the answer is we don't know yet, and we're waiting for additional guidance from the IRS, and so stay tuned with that. We have learned that qualified charitable distributions will remain in place and will still be allowed this year. And so since there are still several unanswered questions regarding these changes, if you have any questions about your personal situation with your RMDs, please get in touch with us and we can walk you through it. Now, what if you have not yet reached age 59 and a half, but you need to tap into your retirement account to help pay your bills during this difficult time? Well, in the past, there was a 10% premature distribution penalty that applied if you took a distribution from an IRA account before that age. With the CARE Act, that 10% early distribution penalty on distributions up to $100,000 for this year will be waived from IRA accounts and from employer-sponsored plans. There will still be taxes due on these distributions, but those taxes can now be spread evenly over the next 3 years. And those distributions can also be repaid into the retirement account over the next 3-year period, which will be a helpful way to help rebuild those otherwise lost retirement savings. Now, because the amount withdrawn is still subject to income taxes and it removes funds that may be needed for your retirement, this should still be looked at and used as a last resort. Instead of taking an outright distribution from your employer-sponsored plan, another option you may want to consider is taking that money out as a loan from your employer-sponsored plan. Now, in the past, 401k loans were capped at the lesser of either 50% of the account balance or a maximum of $50,000. And with the CARE Act, you're now able to take out up to 100% of your account balance, up to a maximum of $100,000. Now, this amount would be reduced if you have any outstanding loans on your employer-sponsored plan. Now, I hope this was helpful. And if you have any questions about these changes or how they might impact your personal situation, please get in touch with us and we'll be happy to review it with you. And for more information, you can also visit the IRS website at www.irs.gov/coronavirus. You'll find more details on the changes and also some additional resources that you may find helpful.